Taxation. Now, taxation questions on the exam are going to fall into two very broad categories, either capital gains or income, and we're going to break these categories down further by security type. Let's begin with stocks. Now, a capital gain is simply the profit realized when selling a security. You want to buy low and sell high, and you're going to be expected to net capital gains and losses to arrive at a net figure and then determine the holding period, whether long-term or short-term. If you take a look at the illustration in the book, you simply want to take your sale price minus your cost basis and arrive at your capital gain. Then you want to look at your holding period. If you held something for 1 year or less, it's going to be considered short-term. If you held it for greater than 1 year, it's going to be considered long-term. As far as netting is concerned, I'll give you an example. Now, if an investor had a long-term capital gain of $2,000 and a short-term capital loss of $5,000, the net would be a short-term capital loss of $3,000. Capital gains converting. Now, when converting convertible bonds or convertible preferred stock, the original cost to acquire is used as the cost basis of the common stock. So, for example, if an investor purchased a convertible bond for $1,100 and then he converted the bond to 40 shares of common stock, his cost basis for the stock would be the $1,100. His cost basis per share would be found by dividing the $1,100 by the 40 shares to arrive at a cost per share of $27.50. Now, capital gains for gifted securities and inherited securities have hard, fast rules. The cost basis for a gifted security will be the lower of the donor's cost or the market value on the day that the gift was made. Again, the cost basis for a gifted security will be the lower of the donor's cost or the market value on the day that the gift was made. Now, capital gains for inherited securities, the cost basis will be the market value at the time of death. Another hard and fast rule, the holding period for inherited securities will always be considered long-term. Municipal bonds. Now, a municipal bond purchased at par and held to maturity will not generate a capital gain or loss. Now, during the holding period, it will generate tax-free income. So if you take a look at the illustration in the book, basically if you invested in a tax-free municipal bond, $1,000, it would throw off tax-free income during the maturity period, and it would mature at par value $1,000. There is no capital gain, there is no capital loss. However, it will generate tax-free income. Municipal bond purchased at a discount. Now, if a municipal bond is purchased in the open market at a discount and held to maturity, it will generate tax-free income and it will realize a capital gain upon maturity. However, there's one consideration here. I'll give you an example. A bond purchased in the open market for $950 and held to maturity of $1,000 will realize a $50 capital gain. However, this gain is reported to the IRS as ordinary income. Municipal bond purchased at a premium. Now, if a municipal bond is purchased in the open market at a premium, the premium is going to be amortized over each remaining year. Now, the amortized amount is deducted from the cost basis. Now, using this method, the cost basis will equal the par value of the bond at maturity, and there will be no tax loss on the position. If the bond is sold prior to maturity, the current cost basis is used to calculate the gain or loss. Now, this is an easy question to spot and work through to a correct answer. Now, the question will typically give you the purchase price and the years to maturity, and you simply divide the premium by the years remaining to arrive at the current cost basis. Now, I'll give you an example on this one. A bond purchased in the open market for $1,200 was purchased with a $200 premium. Now, if the bond has 10 years left to maturity, the amortized amount will be $20 per year. Now, after 4 years, the bond would have been amortized $20 a year for 4 years. It would be amortized down to a cost basis of $1,120. That is the $1,200 that you purchased it for, less $80. Now, to determine a capital gain, loss, or break even, you simply compare the selling price to the adjusted cost basis of $1,120. Again, this is a very easy question to spot and work through to a correct answer. Options. Now, to calculate the tax on an option position, it's necessary to determine the manner in which it was closed. An option can be exercised, closed out through an offsetting transaction, or the option can simply expire. We're going to look at all three examples here. Exercise. Okay, let's say we exercise a call and we purchase stock. Now, the cost basis of a security is the total cost involved to acquire that security. And when exercising a call, the underlying stock is going to be purchased and a premium paid for the right to purchase that stock. Therefore, the cost basis when purchasing the stock will be the strike price plus the premium. Now, we can use the break-even formula for purchasing calls from the max chart to arrive at this figure. And conversely, the total sale proceeds for the writer of the call will also be the strike price plus the premium. And again, you can simply pull that right from the max chart. So, for example, an investor buys an ABC February 40 call, paying a premium of $5. Now, the price of the premium would be added to the price of the stock to arrive at the cost basis for the stock position, which would be the $40 plus the $5 premium times 100 shares, would equate to a $4,500 cost basis of the position used to calculate the capital gain. Okay, let's look at exercising a put and selling a stock. Now, when exercising a put, the underlying stock is going to be sold, and a premium paid for the right to sell that stock must be subtracted from the proceeds. So therefore, the sales proceeds will be the strike price minus the premium. And again, we can use the break-even formula from the max chart for buying puts to arrive at this figure. Now, conversely, the cost basis for the writer of a put will also be the strike price minus the premium. And again, you can pull that right out of the max chart. I'll give you an example on this one as well. Let's say an investor buys an ABC February put, paying a premium of $5. Now, the price of the premium would be subtracted from the sale price of the stock to arrive at the cost basis for the stock position. That would be the $40 sale of stock minus the premium times 100 shares would be $3,500 cost basis for the position used to calculate the capital gain. Closing transaction. Now, an option that's purchased may be closed with an offsetting sale of an option, and likewise, an opening sale may be offset with a closing purchase. So to determine the gain, you simply want to subtract the closing amount from the opening amount, and the difference is your answer. So for example, an investor purchasing a call option at a price of $4 and later selling the call at a price of $6 will establish a $2 gain. Now, the $2 profit times 100 shares will result in the investor making a $200 profit on the trade. Expiring options. If an option is out of the money, it will be allowed to expire worthless, and the buyer's premium is a capital loss for the buyer, and the premium paid to the seller is a capital gain for the seller. Hedging holding period. In Chapter 1, we learned a strategy whereby an investor would purchase a stock and he would purchase a put. And we referred to this as being long with a put. Now, for tax purposes, if an investor purchases stock on the same day he purchases a put to hedge his stock position, the price of the put would be added to the cost basis of the stock. And again, we can look back at the max chart to arrive at this figure. Cost plus premium. For example, an investor purchases ABC stock at $60 per share, and on the same day he purchases a put to hedge his stock position at $5. Now the price of the put would be added to the cost basis of the stock, making his cost basis on the position $65. However, if the stock and the option were not purchased on the same day, they would be viewed as separate transactions, and his cost basis on the stock would simply be the $60 per share. Next, we're going to discuss taxable income pertaining to both dividends and interest, and we'll go over income.